All right, there you go. Okay, everybody. Well, first things first, I want to present you our special guest. This is a special live meeting that we have, and I'm glad to have here Tom Basso. It's a 50-year-old experienced trader, so he has plenty of experience in the markets, multiple markets, not only one market. So he's also a former hedge fund, and the first thing that I'm curious to know, and we're gonna get there, is to understand how, after all these years of experience, now currently you've adapted your trading to your lifestyle. Because I imagine that back then it was quite different. Perhaps you had another approach to the market, and right now we tend to adapt trading to our lifestyles. That's how it should be. And yeah, I'm curious to know. So thank you for accepting the invitation. For the ones who don't know, Tom was super open, and I'm thankful for that. So yeah, welcome, Tom.
Yeah, good to be here, Sarah. I've been retired 20 years. I have time to do some of these. I have been trading for 50 years, so it's not like I have to study hard for these interviews. I think I know the topic pretty well. And so they're fun for me. I can reminisce, I can tell stories. It's a good thing for an old guy like me to be able to do every now and again. Yeah, you're right. Uh, when I was a money manager or hedge fund manager, the I think it applies to what I'm doing now too in this way. I think each trader needs, when they're starting to develop a strategy or to add additional strategies if they're doing multiple strategies, you need to start with what is your objective for that strategy? Are you trying to, if you're a long only strategy, what do you expect it to be? Long only stocks. Okay, so up stock markets are going to do well, down stock markets you're going to maybe get killed a little bit and have to suffer through it. And then maybe sideways, you're just going to watch your profits do nothing. You're just going to be around zero someplace. And that's what you would expect if you step back and think about it. So how you structure any strategy is dictated by what did you place as your objective in the first place. So go back to when I was a hedge fund manager. My job is to manage other people's money. So my objective is to do an assessment of my typical client, my average client, whatever you want to call it, and to try to come up with an assessment of what are they trying to look for, what's their tolerance for risk, what kind of markets are they okay with me trading, and what markets are they not okay with me trading for their portfolio. And when I put all those objectives down and then try to create the strategy that would give them what they want, that's sort of the fence around what I'm going to be doing. The same thing is true now. I'm now retired, so I don't have clients. I don't have to worry about what the average client wants. I can worry about what I want. So a completely different set of objectives, rehauled everything I'm doing. There's very few things that I'm doing exactly the same as I was doing back in my Trendstat days, trading different markets. Some of the markets that are out there now didn't exist when I was back 20 years ago, still trading at Trendstat. So you have to evolve. But the one thing that's very clear is as I add new strategies, I am each time trying to say, what do I want to do with this additional strategy? What hole am I trying to fill in my track record? If there's a drawdown in these 3 months that I'm kind of concerned about historically, what kind of strategy would tend to make money in that type of environment? So I start with a structure around it right out of the gate, and I try to develop a math and a logic that gets me to a strategy that performs well during that period I want it to perform well. And then I try to understand historically, where is this new strategy going to have a struggle? Because most strategies do at some point. I want to, from a psychological standpoint, prepare myself so that I don't abandon a good strategy when it's doing exactly what I would expect it to do in the environment that it's in. And the environment is rough, so I expect that particular strategy to struggle. Then it's not broken, and I don't try to fix it. And I think that's the key lesson I learned from sort of managing other people's monies and then now managing my own. I think there's a little bit
Mhm.
of the same thing, but boy, the objectives are way different for me. I have a completely different profile than my average client did. So
Yeah, no, that
it's
makes a
been,
lot of sense.
it's been a lot of fun, by the way. I've enjoyed
I
retirement
can only
planning. As everybody who reads my posts knows, I have a good time.
No, I'm sure you do, and you have your hobbies and golf, and so it's an interesting life, I'm sure, and it makes a lot of sense to think about the goal and think about how the strategy gonna gonna make sense for the whole for the whole system because you have a lot of strategies. Tom doesn't only is trading one single strategy in one single market, but multiple of them, and I was watching I watched a lot of your interviews, and I watched one today as well. And I discovered, I learned that to become consistently profitable, it took you around 4 to 5 years. And I think this is so important because all the traders that are in this group, they are somehow looking to, they have their strategies mostly, and they are looking to improve that performance part, which involves psychology. So yeah, my question to you is, well, I know that at the time you were a chemical engineer, which is very interesting. So you're actually in the job, so the pressure was removed a little bit, but more about the psychology side. How was it to see yourself making losing year after year, right? And what kept you going?
Well, what I did was being a good engineer, I guess had to write a lot of things down and had logs and sort of monitored my own progress, I guess would be the way I'd put it. And what I realized when I was starting out, I was trying to be more discretionary, try to outsmart the market, and try to be brilliant in my thinking about what the economics out there around the world were doing. Read the Wall Street Journal, do all these, take newsletters and try to look at other people's opinions to try to ramp myself up the learning curve as much as possible. And something profound, an old engineer who used to sit at lunch with me he said, Tom, what makes us think sitting here in St. Louis having lunch and talking about the markets are going to be able to outsmart all these high powered people with all sorts of connections on Wall Street that spend 16-hour a day doing this and have all these resources at their beck and call. And I got to thinking about that and I thought, that's kind of right. Why don't we just try to be better at measuring what the markets are doing and reacting to it instead of trying to play the same game that Wall Street does? And to some extent, the Wall Street types, you got to realize they're managing billions of dollars. And to move $1 billion, having managed 600 million even in my day, it's a lot of money to move. And it's when they call it, work, it definitely is. It's you can't just drop, hundreds of thousands of shares of some XYZ in an order into the market and expect not to start moving the market over the short run. So your fills would be lousy and your cost of
Mhm.
trading goes up and your performance suffers. So you have to work it. So they have to figure out what they want to do, move it slowly, and get their positions built. As an individual trader, which probably most of the people on this call are, maybe all of them, you'll find that you're moving a lot less money. And so the market doesn't even care you exist. You can go in and out and you'll not affect anything. Trust me on that. So, and even at my size, I do trade millions still, but it's nowhere near the 600 million that I was trading for clients. So I find that I can use things like stop orders. I can get good executions. I don't have to worry about moving the market at all. And I can sort of just react. So all I got to do is measure what the markets and the prices are being pushed around are doing. And then immediately, maybe with a stop order or immediately at market, react to what is happening up or down. And so every up move, I'm always in on it. Every down move, I'm always short. And every sideways, I get chopped a little bit. But it's sort of part of the game. And I, every major move that happens, which is going to come along every now and again, certainly the last part of this last year seemed to be really good for stocks. Much to my surprise, I wasn't predicting it for sure. As a human being, I would have said this market is very vulnerable. Wouldn't be surprised if it sold off. And I made some posts to that effect. But much to my amazement, all my indicators picked up on the trends. I went long. I was 30 out of 30 sectors long in my ETF upside timing program. And I was long stock indices futures. I was long cryptos. And so December was a fabulous month for me, much to my amazement. So the lesson to be learned there is that 4 years that it took me to get to break even and beyond, it was really just understanding that I've got to just react, and I've got to do it in a disciplined fashion without trying to predict and not trying to, outsmart all these Wall Street types and other big money. And life became easier after about 4 or 5 years. I just started cranking it. The money machine just kept going, and I just kept doing it over and over again. And I've been doing that for like 26 more years now. I'm up to about 50, I guess, somewhere around there. And that's kind of the key to success.
Yeah, I think when you look back on those 4 years, might seem nothing compared to all the advantages and everything that you can then in the future. Yeah, and I wanted to touch base here on. I think it's interesting before we hop on the performance and psychology side. A brief explanation about your strategy. Nothing or strategies, nothing in details, but like some key principles that. Well, I know you are very price driven, and the key principles that you look for when you are backtesting a strategy, or you're on your current strategies right now of the different markets.
Well, what I try to do is I'm price driven, and the reason for that is statistically I found when I've done studies that the closer price moving produces your profits or losses. If the price goes against you, you lose. If price goes your way, you win. Because of that, the farther you get away from price. So let's say you come up with a strategy that says, when interest rates over the last 5 days are moving lower, I'm going to buy stocks. Okay, so now you're one step removed from the price of stocks. You're measuring interest rates, and you're hoping that means stock prices move. Only what you find over time is it's not 100% correlation. So every time you're not correlated, so the interest rates makes the move, the stocks go the other way and catches you completely the wrong direction, then you're left in this quandary of, all right, now what do I do now? So the logic breaks down in how you're going to try to produce a profit. So I stay close to trend following, and I do it based on price. And then what I try to do is diversify. Right now, I'm up to 10 strategies across 4 accounts, and that I manage, which is 2 for my wife and 2 for me. And 2 of those accounts are retirement IRAs, and the other 2 are taxable trusts. And so I have different strategies to try to solve the financial puzzles in each of those little accounts. In some of the accounts are smaller, so I've got to come up with strategies that work for a smaller amount of money. Others are bigger, so I can diversify more by strategy and all that. And so when I can diversify across all 4 of these accounts, I consider how many markets can I trade in realistically and not have to work all day. That's one thing. So I'm trading right now, I probably own across all 4 accounts somewhere in the 60 to 70 different positions. So that's one form of diversification. The second form is by strategy. As I mentioned, I have 10 strategies. So each strategy might have its own indicators that are measuring trend. My favorites would be things like Keltner, things like Donchian, things like Bollinger Bands, all of the strategies that have a top and bottom band so that I can ignore the noise between the top and bottom band as an area in the market that I just want to ignore. That's normal market movement. It's just going sideways. Prices go up and down, but they stay within a range, and I don't want to take action. And when the gets through the top band, I like to take action on the buy side. And when it goes through the bottom band, I want to take action to the southern side, sell. And So that's another way. I've got probably 5 different indicators that I use all totaled, and that gives me additional diversification. And then the next thing I think is really easy for everybody to do is no matter what indicators you use, consider time diversification. I only operate my stuff once a day, but I have a 3-day strategy, I have a 9-day strategy, I have a 21 and 50-day indicators that I use for another one of my strategies, and 2 strategies actually. And by doing that, you'll find sometimes, in fact, frequently, you'll find that in your long-term strategies, you might be long, but then a short-term strategy ends up going short, and the 2 positions will offset each other, sort of take you out of the market until the market figures out what it's doing. So all of a sudden, you'll get this choppy sideways, but you'll be sitting there with no position. Really, you're long one and short the other, but they offset each other, and it just kind of keeps you gliding through this sideways. And then all of a sudden, the market figures out which way it wants to go. The short term maybe gets back and matching the long term, and now you're loaded up and you're catching the trend and you're making a lot of money. So that's kind of the way I deal with diversification: time, indicator, strategy, instruments. Try to
Yeah.
work all of those to your benefit.
Yeah, that's super interesting, and it makes me remind of an article that you put on your website, enjoytheride.com, and I think it was yesterday that you were talking about edging. A lot of people wanted to know how you edged, and so I guess my next question to you is about risk management. For being able to have this entire career, 50 years, and going through a lot of different market conditions and I imagine drawdowns, tough conditions, slow markets, whatever was thrown at you. How was your approach to risk management?
Uh, at first, not good. My first trade was a corn trade when I got into futures, and I lost $600 of a $2,000 account, and I had no clue what I was doing. And so that was coming from zero risk management, as far as I could tell. And little by little, I guess the most profound mentor, if you will, was when I read Larry Height's chapter in Market Wizards, the first book. And Larry uh, doesn't even have a high school education, but he's a smart guy. And he did everything in the markets and trading sort of with a gambling analogy. So even though I don't know that he's a professional gambler or anything in casino land, he viewed taking a position as a risky, situation, and you need to manage your bet size. And he called it that. And I thought, bet size, that's the amount of money you could lose. So what he's doing is measuring the risk on the trade, and he's making sure it's a consistent percentage of his total equity, maybe. So I started examining that math. This was probably, had to be 6, 7 years into the process for me from the time I started trading. And I suddenly realized when I was managing my bet size, my historical simulations, my performance curves start getting a lot smoother and more predictable. There wasn't this, make a huge amount of money and lose a lot of money, which tends to take your psychology all over the map. You're giddy one day and you're depressed the next. Now it was starting to say, okay, well, every trade is the same as the last trade risk wise as a percent of my equity. So I shouldn't get overly concerned over any one trade versus any other trade. They're sort of just a data set of my next 1,000 trades. And so it takes your psychology down to not focusing on the single trade, but to more globally, strategically figure out how am I going to reproduce what I'm doing 1,000 times to get 1,000 trade database, so I can really analyze the real life of either success or failure, but with a very large sample. And once I read that chapter and started working with that math and doing that position sizing, which is the same exact math that I put in my position sizing book that's available all over the place between enjoytheride.world, my website, and Amazon and other places you can get it. And it's sold many, many thousands of copies now. It's all of $10, so everybody probably can afford it. Um, that math allows you to sort of properly position every single trade versus every single other trade. I don't think a
Mhm.
lot of traders think through that. A lot of people will get stuck on I trade 100 shares of stock. Well, 100 shares of Amazon might be different than 100 shares of Meta because they're different prices. And even if you put the same dollar amount in, uh, 100 shares of Meta might move a lot differently volatility wise than 100 shares of some utility stock. So how do you normalize that? Well, you do it the same way using volatility. You say, all right, I want a half of 1% of my equity to be the volatility of this one position, number one. And I got number two, and I look at its price stuff, price movements, and I say, I want half of 1% of my equity as volatility from number two and number three and number four. And what you've done by the time you get to number 10 is you have 10 stocks that are all moving with respect to your equity, the same exact speed, so they can contribute the same to your profitability or your potential for loss. And again, you're trying to smooth out your psychology so that all 10 positions are like your children. You love them all. They maybe act a little different, but they're all part of your portfolio. You're not favoring one or in another. You're not doing twice the volatility in position A versus B. So position A dominates your performance, good or bad. You've smoothed it all out. And so
Mhm.
that's been wonderful. Larry Heights, and I've talked to Larry now and commented on his book that came out a while back. And um, so now we know each other better than, I knew him as a young trader back when, and he didn't have any idea who I was. But Mint was $1 billion operation when I was getting into the CTA business, commodity trading advisor. And so I always looked up to Larry and his operation, the way they operated. And uh, it spilled over into a lot of development of math in my head and put it in place in Trendstat and used it very successfully for many years. And I still use it today, 20
Yeah,
years of retirement.
that's incredible, and it's a perspective shift, and it allows you to detach from the trade and achieve this big picture that many times is what messes up with our performance as traders, because we get stuck in the tunnel vision, fear, greed, and all those emotions, and the big picture is lost. So that really risk management, I think, it's halfway to solve, or much more than halfway to solve all the trading psychology mistakes. And so that is such an important requisite. Do you consider yourself, now I'm curious, more of a, regarding risk tolerance, more of a risk taker, or more conservative?
Well, it's interesting. I get labeled with weird labels by people like friends that have no idea what I do, or um,
Right.
they know I live in a nice two houses. Well, although the second house is being remodeled, I don't live in it yet. I'm in a hotel room, as you can tell. Um, I I have to say that a lot of people consider me much more of a risk taker than I feel like I personally am. I feel like people probably label me with a little more risk tolerance than I probably choose to try to shoot for, at least. And in reality, I probably do. If I got hit with a 20% drawdown, I'd take it in stride as long as I understood how it happened, and I would, if the market deals me that, I accept it graciously and just keep on doing what I'm doing. But I wouldn't like it any more than anybody. I wouldn't freak out like some of my retail clients would have in the old days that know nothing about what they're doing. But when I consider the math, let's say say I'm doing sector ETF timing, long only to cash. So long only, market goes up, I make a lot of money. Market goes down, I'm in cash, earning interest rate. So that strategy I know is going to do well in up markets, as it did the last part of the year, and it struggled a little bit this year. Then over here, let's say I got 26 futures markets and I'm trading that on a long-term basis, more like a probably 9+ day basis. I have an indicator that is too complicated to explain. It's not a standard one, but it's one which I invented a long time ago. It's just easy for me to use it. And that type of stuff has nothing to do with each other. If I trade corn, it doesn't care what the US stock market is doing. It doesn't care whatsoever. So it could go up at the same time stocks go up. It could go down while the stock market's going up. It could go the other way. I can go long and short in that type of strategy. So there's a completely unrelated return stream that I've got going on. So when I put those two together, people hear the word futures and they say, oh my God, he must be really aggressive and speculative and risk taker and all that. I look at the math and say these two things are many times offsetting each other. It's a risk reducer. It's an improvement to the return to risk ratios, which in my mind means I'm improving the way I'm dealing with risk, and I am taking on less risk. So that implies to me mathematically that I'm not as much of a risk taker. So be careful with labels. I get a lot of people. I've got one guy that he's really cute. He got a hold of my email and he sent me this randomized email. And he said, I'm sorry I'm sending you this anonymous email, but I can't reveal who I am because you might know who that is. But I have some questions if you don't mind helping. And I helped. And now he wants to do a Zoom call. He's finally warmed up to me, I guess. But, when you look at how he goes about what he does, he immediately dismissed futures because of the image futures has. He says, oh, that would leverage my portfolio too much. And the truth of it is, if you understand futures, you can leverage it or you can non-leverage it. You could go buy a futures contract in crude oil and pay cash for the face value of the crude oil and have zero leverage. You own crude oil. Cash, zero leverage, zero chance of a margin call. So it's all a matter of how you dial in the leverage. And most people don't understand that because they just dismiss it based on the image. But the way I'm looking at it is mathematically, I'm reducing risk. So isn't that a good thing? I'm improving the return to risk ratios. That's what I constantly am trying to do.
Capital preservation, yeah. And then that's the focus. It's not the upside, it's more on capital preservation. And so when we understand the market dynamics and how the different markets move, we can take advantage of the different markets for their different ways of moving. And yeah, it makes a lot of sense. All right. Yeah, Tom, I'm really curious to know now, with so many years of experience, what would you consider some of your biggest challenges, technically, psychologically, performance-wise, in any market throughout your journey?
The biggest challenge for me sometimes is just my schedule. Back when I was a money manager, I'd travel around the world and then trying to put staff in place and computers in place and programs in place so that I could get all this done and comply with my job as a money manager. That was probably some of it. But even in retirement now, I do some traveling. My wife was a real estate person all of her life, so she didn't get to travel. And I, of course, traveled a lot. So she would love to see some of the world that I've seen over my lifetime. So we've gone out and done some of that. And in my case, I was traveling for business. I didn't see a lot of the world. I saw the inside of a hotel room and then meetings with clients, and then I'd get on a plane and go to the next place. So that was one challenge, is just timing. Another challenge, I would say, is finding the time in my sort of schedule to sit back and to think strategically, to sit and say, okay, Tom, you've got 10 strategies right now that cover 4 different accounts of different size, different objectives, different needs. What does strategy 11 look like, and where does it get put? Which of these 4 portfolios has the ability to take on an 11th strategy and has the dollars for it, has the need for it, in terms of the internal structure of those things. And that requires, I mean, this 10th strategy I just rolled out, I've been thinking about and developing for probably about 6 months now, at least, maybe 7, 8 months.
Wow.
And finding the time to just sit back and do some of that work and to do some penciling and do some word processing and just kind of free form my thoughts on what am I looking to try to create. And then to sit down and try to, logically lay out the decision making that this strategy will have to do, and to figure out how much of it can I automate so that I don't swamp myself with, 8 to 10 hours of work a day, because I do like retirement. That's probably some of my biggest challenges. Other than that, I've gotten way past the psychology of following a strategy or getting unnecessarily focused on any one trade, or a lot of the things that new traders seem to have difficulty with.
Yeah, I mean, at the time, I imagine that when you were starting out and everything, that the topic wasn't so talked as it is today. Nowadays, we go on social media, everybody has an opinion, and we don't even know how legit is the person. So it gets very difficult for a new trader to find the right path and shut down the noise. But
Yeah,
back
I had the
then,
opposite problem. When I was starting out, we didn't have the internet. That's how far
yeah,
back I go. So
very,
I had nobody to mentor. I mean, I read Market Wizards, and that was just fascinating. It's why Jack Schwager's been so successful with it from all of back in those days. There just wasn't anybody out there that you could just, send a direct message to Tom Basso and ask him a question that he might answer and might solve a problem that you've come up against. And I think it's a whole different world. And now it's flipped to the other side, where you can get so many opinions, you're confused. Before, you were confused because you couldn't talk to anybody, and now you're confused because you can talk to everybody. And so it's a different world we live in, and very fast paced. And,
so
I think that's hard to sift through all of that.
yeah, now the challenge is filtering, and it can be one of the bigger challenges actually than finding somebody to give you direction. But yeah, right.
But
So there's actually here in the group a lot of traders that struggle with overtrading and being disciplined. These things that you said that now you just obviously got past that, and they would like to hear some of your comments and thoughts on these struggle performance flaw, the overtrading, the impulse to take a trade that's outside of their strategy. And it's a very broad topic, but what would you consider are some key things that need to be there in order to kind of eliminate that?
for
That
me, for me, it would be, I believe that when you start out, you spend a lot of time in your conscious mind with the strategy and the setups here, and I've got to do this buy of that many shares. I position sizing, even if you're smart enough to do position sizing, and you get everything ready and you hit the button and it's transmitted. Now you're watching it and it's going your way. Great. Your conscious mind is totally into the mechanics and the excitement of the profit, or the frustration of, oh my gosh, it turned right around as I went into this thing, and now it's going to take my stop out. Do I cut it off early and cut my losses short, or do I just let it hit the stop, or do I, it's close to the stop, maybe I double my position, whatever. And to me, it all falls down to one thing that I think a lot of new traders don't do, is to have that sort of observer self or awareness that, okay, Tom, you got into the trade, everything's cool, and I'm watching Tom get nervous about this trade, or I'm watching him get greedy, or I'm watching him sort of getting frustrated. Uh, so awareness of what you are doing, and if you have to put a note, a sticky note on your computer that says "Be aware," and just remind yourself to kind of pause a second and say, well, how aware was I of what I was just doing? And what you'll find yourself doing is sort of watching Tom trade instead of Tom trying to trade. You start watching Tom trade. It's sort of like watching a movie. And just like a movie, you find yourself being able to laugh, to be horrified at some things if you choose to, or you can say to yourself, Tom's just executing a dumb strategy. Just let him do it. And when he gets out of whack and he's going off of that, be aware enough to put yourself back with discipline on the plan. So to be aware that you're varying from your strategy and to immediately put yourself back on the strategy, that is the key. And how do you get awareness? I don't know. It took me probably the better part of 10 years to be as aware as I am now. Pretty much the last, I'd say 40 years or so, I pretty much figured out how to be aware of what I'm doing myself. But um, it takes different people different ways. People process thoughts and do things differently. But I have to say that with no awareness, it's really hard for you as a trader to know that you're going off plan and to figure out a way to get back on plan. So you end up sort of hit and miss doing different things and you're all over the place. If you can be aware that you're doing that and tighten it all up, then it becomes almost simple, because it's almost like you don't want to hear your observer self say to you, Tom, you're going off plan again. You don't want to be criticized by the observer self. So you just sort of accept it and say, okay, I've just got to execute flawlessly every day, do my plan, execute it flawlessly, and then go find something else to do. And it just becomes a lot easier when you take on that kind of
Yeah.
mentality, and you just kind of keep cranking.
That is such a great advice, Tom. It's like when you are able to detach from your own body, which is weird, and kind of see yourself as a movie. Your sense of self now all of a sudden it's not all mixed up with the things that are going on inside your head. It's a different stuff, a different thing. And so I sometimes use this concept, which is the power, the seat of power, and which some traders, they are trading and they think they leave that seat of power from time to time, but they actually never stop being there. And so when they perceive they left the seat of power, I think it's when they mix up themselves with these thoughts. But if they remain, just like you said, detached and then looking at the movie, they can have much more self-control. So that makes a lot of sense. And yeah, with so many years of experience, you probably were able as well to practice this self-awareness and to refine and to, because I believe that some people are better at self-awareness from the start. I think it has to do with education, genes, whatever, a mix of both. But it's something we can practice, and so yeah, that's really important. All
Mhm.
right. Um, yeah, talking here about the skills, not the skills that it takes for a new trader to become successful, but a more interesting question, I guess, is what do you think are the skills that takes a trader from profitability to kind of breaking that pattern mark? Because what happens with a lot of the traders I guide is that they achieve many times this plateau, and they can't get past that. And it might have to do with a limiting belief, this or that, for some reason, and they just can't get past that. And so yeah, my question is how um, did you got out of, if this ever happened to you in any time of your trading career, and how did you got out of it, and what you think traders should do in this situation?
The, I guess the most profound moment was, when we were getting up in the hundreds of millions under management. And of course, with all my automation, I had software that I could just go onto a main menu of my computer and say, let's check what's going on. And you look down at the bottom and you're trading hundreds of millions of dollars, and all of a sudden you see that you're down $5 million today across the client monies. And it sort of all of a sudden strikes you, wow, that's a lot of money. and and then you start thinking about it and you say, well, wait a second, it's only 0.4% of the assets I'm managing, or something like that. Or it's 0.6. This is not a it's just like every other 0.6% when I was trading less money. And the thing I started realizing was that uh, sort of take care of the process, let the results take care of themselves. Think like an Olympic athlete. What do? They work out and work out and work out, and they train at high altitude, and they do everything they can. They might pack their blood cells, which would be inappropriate, but imagine some do it. They do everything they can, and then it comes time to perform. And if they've done their work right, they're ready to perform. And I think a lot of traders come to the trading world, and they're essentially gamblers at heart. They love the excitement of the gamble. They're not trying to be successful. They're trying to get excited. They're trying to have fun. And the fun may even involve losing money because it makes the thrill of making money that much more exciting. And so there's a little bit of erratic performance. Their emotions go all over the place, but that's what they're trying to obtain from the market because they can't get to the casino while they're working full time or something. And I think a better attitude is to get into the mind of I'm going to do this the rest of my life. I'm going to perform at the highest level I can personally try to figure out how to perform. And anything I'm doing today is just one step in this very, very lengthy process. And I need to do it the best of my ability every day, day after day, just like an Olympic athlete would do. And you need to train. So things like, do you have caffeine or not? Do you do drugs? Do you do alcohol before you're trading? I knew of one guy I asked from Poland, actually, and I asked him, he was an FX trader, I remember, never forget this, because I just broke out laughing after I asked, how do you manage risk in the FX markets? And he said, I have a bottle of vodka on the shelf right over my monitor. And if I get nervous, I have a sip of it. And I broke out laughing. That was his risk management. Oh my gosh, that's a little bit wacko. But that's not what an Olympic athlete would be. Okay, I'm going to train. I get up at the same time. I have a healthy diet. I get my body fat down to 8% or some ridiculous level. And, they try to set a world record. You're not going to set a world record if or just show up at the Olympics with no training. But
Oh,
that's what a lot of traders think they can do in the markets. If I buy Nvidia, I could, retire at 30. It's not that easy.
no, what I see a lot is that um, traders think that trading is like a side thing on their lives, and that it's an isolated thing, and that there's no influence in other areas of their lives. And so um, they end up they are impatient people and undisciplined on their natural state in their daily lives, but then they want to harvest these skills. They want to cultivate this in trading, and it kind of gets, it's two opposing forces. And it's so important what you just said, to know that it's all emerged, that we are trading as individuals, and everything counts. And when we take exceptional performance to outside of the charts and arranging our life to really for the sake of good trading performance, every aspect, the food and the exercise, the mental well-being, it really it's like a different type of commitment. You're in there for, you're living for that. It's a different type of commitment. That's valuable. Yeah. Yeah, I have here an interesting question from one of our members, and I think this is so uncommon to ask. That's why I think it's great. And I'm gonna ask it to you just like he asked it. So if there's such a point, at what point should a trader give up?
Hmm.
And it's
Well,
uncommon, right?
that would be an unusual way. I guess I would give up if I didn't have enough money to do it. If you've done a trade and you've taken your account down to less than $500 and it's almost impossible to trade, I would definitely concentrate on my day job and get some more capital into the account before I start it up again. So that'd be one point. I think another point would be is if you realize, for whatever your circumstances in life were, that you really need to pay attention to family. Maybe you've got a parent that's on the last stages of life, and you're going to need to be 100% focused on helping them through their last months. of life, something like that, or if you got a brand new baby that's requiring, because you're the going to be the spouse that's going to be doing most of the work, you need to concentrate on that. You're not going to have time to focus on trading. There's certain things. Van Tharp, who used to, Sarah probably knows, used to be in the investment psychology world, and unfortunately passed away a few years ago. He used to say that when you get divorced or you have traumatic events in your life, you may want to just put trading aside a little bit until things die down and you can focus on it a little more. Yeah, especially if you're doing more discretionary types of things with your trading. Uh, but even when you're a systems trader, you're more likely to jump in and override a strategy, or make an impulsive decision just to jump in and do something, because you're not balanced with your mind. You've had
Mhm.
trauma, or you've got a situation that's really weighing on you. That's probably the time you want to think about pauses. It's not like you can quit altogether. You might want to give it a little rest for 2, 3 months, take a little hiatus, and then come back much mentally stronger with a plan, and attack it again. But that's kind of the way I look at it. Most of the life for me, I've been able to manage my personal life. I've had a lot of good fortune, had a great wife who accommodates my sort of an hour a day, no matter whether we're on vacation or not. I've got to do my afternoon run. She knows that. She builds it into the schedule. She always finds hotel rooms with Wi-Fi for me when she's making arrangements. So she understands some of the problems that I have, and helps me solve them before they become problems. So that's been a blessing. That's kind of the way I would put it. In those instances, you might want to shut it down, but the rest of the time, I recommend another approach, which is to say, look at your life, because everybody on this call has got a different life than, say, mine or Sarah's, and you're going to be able to imagine things real simple, like the internet goes down. That's a simple one. We've all probably had that happen. Sarah, maybe more recently, with her switch over to a new internet system. But that's one thing. Electricity could go off. Your computer could malfunction. Your brokerage firm's platform might go down. We can all, if I asked for everybody's suggestions, we'd come up with another 15 things. Your kid gets sick at school and you get a phone call in the middle of the day saying somebody's got to pick them up. Um, so there's lots of things in life that, while they don't happen very frequently, could interrupt trading or play games with it. Your data
Mhm.
provider doesn't have the data on time. All those different things. And you got to develop a plan for each one of those things. What do I do if the electricity goes down? Oh, well, I've got batteries here and I've got a battery there, and that's not a problem. I can just keep functioning. Internet goes down. Okay. I need to go to a separate internet system, and I happen to know several that are right near me, that 5 minutes away, I can be back online. So I've thought through those things. I have plan B, plan C, plan D in some cases.
Mhm.
That takes the stress off, and it allows you to keep going when life throws you those unexpected curveballs. But the first
Yep.
part, where I'm saying, like you got a parent that's dying or something, and you're going to have to focus on that. Just back off from trading and say, okay, I'm going to take a break for 2 months and let's try to do what's right. And
Yeah.
you'll feel a lot better for it in the long run.
I do believe a lot of, pretty much all of us already have those situations in play. But what happens is that some of the traders here that I know, you kind of try to force yourself into trading, even in those situations, because you want to prove yourself. It happens with a lot of traders. They think they are still capable, and there has to be a lot of allowance needs to take place in order to
Mhm.
be quote unquote humble, to understand, okay, I'm not in the best, and I will allow myself to, because I don't want to put my capital at risk in these conditions. The mental edge needs to be there, and the technical edge one. It's
Yeah.
not only the technical one, so both together. So yeah, it makes a lot of sense. Now, but do you think, you're coming back again as well? Do you think all traders are born to trade? Do you think there is a specific mindset that one needs to achieve or needs to be born with? Do you think it's for everyone, or not? What would you say?
Wow. I wasn't born with a knowledge of trading, and when I started out, I had no clue what I was doing. I think some of my engineering brain, my heavy math brain, my computer skills, because when you program in a computer, you're trying to teach a circuit board that is super mindless to do all these things that a human mind can do so easily. And you realize how stupid a computer really is when you sit down and try to code a trading strategy, and then try to get it to work the way you know you can do as a human being. Uh, so you get a heavy dose of logic, and I think that helps probably in most in most trading situations. In that, I think there's sort of a feedback loop of I'm going to try this, and then I get rewarded or not. And what did I learn from that? And then you get better and you get better. And after 4 or 5 years, you start realizing that, this is working for me and that's not working for me. And you kind of do more of the things that seem to work. And I think that some of that is available to everybody. I don't think I was born with some kind of a special brain that was conducive to me being Mr. Serenity at all. I think that's a learned skill all the way, including being aware and I had to learn how to be aware. I had to learn how to have self-confidence. In high school, when I was giving a book report, my hands would shake. I would be completely distraught and nervous and so afraid of being in front of groups. And now I do these interviews in front of who knows how many people. I have fun. I enjoy it, but that's been the transformation that I've made over my lifetime. And so I think that it's a learned skill. And I think you just have to figure out what pieces of it do I already have and what pieces am I missing, and try to just like the athlete that analyzes, okay, uh, I'm going to play basketball, but I'm not as tall as a 7-footer, so I'm going to have to play. I'm going to have to be faster, or I'm going to have to be more accurate with my shooting, or whatever I can do to take my personal inventory of skills and capabilities and maximize the ability to do what has to be done. And so, hey, I know computer programming, so it's real comfortable for me to try to sit and write code. Not so much these days. I have other people that'll do it for me, because all the different languages that have come out since I was programming, I haven't had the time to learn them all and keep up with it. So there's other people that are far smarter than I am in that area. But I understand the logic of a computer program. The point is, nobody's born with a knowledge of programming. There's courses on Udemy, Udemy, that you can get in C# for $15 and do it over your computer. There's no
Incredible.
excuse. If you want to know something about programming, take one of those courses. Take 5 of those courses. Pretty soon you'll be doing programming.
Very
There's just, you have to figure out what you need. And I think one of the Hunt brothers way back when said, figure out where you're going, figure out what it would take to get there. And 3, and that's where you lose a lot of people, is be willing to pay the price. A
yeah.
lot of
That
people
is
a lot of people think they know I'd like to do what Tom does. All right. Well, yeah, I've been doing it 50 years, and it's taken a lot of time to get to where I am today. And it doesn't just all of a sudden luckily happen. I had to, day by day, learn programming, learn math. I got an engineering degree. I worked and built my capital up by working as a chemical engineer for a number of years. I struggled and strained as a money manager. I mean, when Jack Schwager put me in New Market Wizards as Mr. Serenity, I had already been in the business for a good, uh, in various stages, almost 20 years. So I was a 20-year overnight success. So nobody knew me before Market Wizards. Now everybody knows me, and it's the whole world goes nuts. But you know, that
The
didn't
greatness is
change my
already there.
thinking. I had to learn all that stuff day after day after day and keep
Yeah,
pushing.
totally. It just didn't happen all of a sudden. It was already there. You had already achieved greatness, but then you just got known after, I guess, with market wizards as well. It was a big boost, but yeah, I think trading englobes a lot of different personalities, and sometimes it's as well trial and error to understand. Okay, our personality, understanding our own weaknesses and strengths, and understanding what fits you better. The problem, I guess, with today generation is that there's a lot of people lost, and they just don't know what are their weaknesses or strengths. And
You got the
exactly,
phone going all the time. They're
yeah,
sitting there at dinner with a date and they're going like this to each other.
yeah, and everybody is just here walking lost, and then they are disconnected, and so it becomes more difficult to achieve that important skill that you just referred in the beginning, the self-awareness. um,
Yep.
it really becomes difficult. Their sense of self is attached to external things, but yeah, talking here about the strengths, I think it's important to ask you, what are the three biggest trading strengths or strengths as a trader you consider yourself to have, those that helped you overcome your biggest challenges, that were always there,
My
that helped
biggest
you.
strengths as a trader. That's a great question. I would have to say self-awareness,
Hmm.
self-confidence, or self-esteem, however you want to, put that sort of area of, realizing that I have some strengths and I have some weakness, but a certain amount of being okay with whatever those are. And then I think a logical way of thinking. I those would be my top three: awareness, self-esteem, and logic.
That is so important.
If you can combine those three things, it seems to me you'd be able to come up with a plan that you want to execute, and you'd be aware when you're going off the plan, and you'd have the self-confidence and esteem to keep going no matter what.
Mhm.
Those
Yeah,
three things probably would be very, very helpful.
yeah. Now, without you really realizing, you just offered a lot of answers, I guess, to a lot of the people here. I think self-confidence is a major one. Self-awareness. So yeah. Thank you for that. Okay. Yeah, Tom. I have here a question before we go into this question that is here on the chat, because then if Tom has an extra time available, if you guys want to ask him one question here and there, um, we're gonna have a Q&A in the end. But yeah, before that, somebody asked you here in the group, if you had to start all over again in today's market environment, what key principles or strategies would you prioritize, and how does that differ from your approach when you started?
Oh my gosh. Well, when I started, this is going to be a little easier than you think it would be, because when I started, I was in the 70s, coming out of school. It's 1974. We programmed things on IBM punch cards and ran them through big vacuum tube computers. So and there was, when in 1974, at the end of a 50% down S&P 500 index, in the December of 1974, and into a bull market in 75 when I was out of school. You are talking a period where all the trades were done, like 10 million shares traded on the New York Stock Exchange was a break open the champagne day. Huge volume. And now SPY's, the ETF, Standard Poor's 500 Index ETF, does over a couple hundred billion, I believe. Is that right? Million shares a day by itself. And there's trillions traded every day. So the world is completely different. ETFs did not exist. There was 500 mutual funds when I started out trading. Very quickly, within a decade, there was thousands and thousands of mutual funds. So what would I do differently? In today's world, back in that world, I had to trade mutual funds and time those. I did some stock purchases. I dabbled in some options, and I started my futures trading, and there was really only maybe 30 futures markets that I really got excited about. Today's world, I would heavily orient myself towards data processing more because there's so many more trading vehicles out there, and as a human being, you just can't cover them all. But with a computer, you can do a lot. So I would heavily lean more towards computers in today's world than I would have back then. And the other thing I would look at is liquid instruments more. So I would look at, say, the top 30 futures markets because you could easily trade. I'm the chairman of a mutual fund called Standpoint Fund. It's the Standpoint, alternative asset fund or something. What is it? I can't remember the exact name. BLNDX for those who want the ticker. You can look it up. But I'm the chairman of that fund, and they trade 75 of the most liquid futures markets around the world, combined together with ETFs that cover the globe as well. So you've got 50% of the money over here in kind of the stock land around the world, and another 50% sort of is covering 75 different macro markets. And I like that approach in today's world. You're going to need some way of sorting through, say, 75 different markets worth of price data and taking positions. You're going to need capital. I would strive very heavily to start with a larger amount of money than I started with back in the day. I started out with like a couple $1,000s and got this all started. In today's world, that's not enough money to do very much. You're really handicapping yourself. I'd really strive to get up into the $15,000-$20,000 maybe, so you can do a few bells and whistles and get going, diversify yourself. That's kind of the differences. Other than that, you still need the awareness. You still need to kind of teach yourself some lessons, maybe with a few losses that you let get out of hand, and hopefully it doesn't wipe you out and you learn some lessons from it. But I call it the college of trading. Your losses are just the tuition you're paying to learn what you need to do. And sometimes the tuition gets expensive, and sometimes you luck out and it doesn't cost you that much. But that's kind of the differences, I would say.
Yeah, fantastic. Yeah, right. Okay, we have here a question, which I think is interesting. It's here on the chat, and it's from Diego. And he says, you mentioned about developing the self-confidence. Do you have any tips beyond being aware of the self / observing our behaviors and thoughts during trading sessions? And I guess if you, it would be interesting to know if you used any techniques, like, I don't know, that helped you physically, that helped you achieve the self-confidence, or outside of the charts. What would you say?
Well, I can tell you what I did back in the day to improve my self-awareness. I'd say at this point, I'm pretty self-aware. I don't need any tricks anymore. My brain sort of just functions watching Tom all the time now. I mean, I've got a part of my brain that's watching me move my hand right now. It's just instinctive at this point. But what I did to improve my self-awareness was to, at first, do something that ended up being a bit stressful, or it was sort of an event. Like I had to get up and give the book report, and I found my hand shaking, and I got done with all that, and I found a quiet spot, and I said, okay, that was ridiculous, Tom. I've been friends with these people all my life. I know everyone by their first name. I went to elementary school with them. I was in a small town. I knew these people. Why am I nervous getting up in front of them and talking about a book that I really did read and have an opinion on or whatever? This is just stupid. And so that was the first stage. Then the second stage was to get it a little bit more real time, which would be more useful in trading, because I guess it's one thing to go through your trading day and then at the end of the day look at the log of how you did different things and made certain mistakes, and then kick yourself psychologically and say, you dummy, why did you do that? That's not even your trading strategy. That's stupid. That's at least better than not doing it at all, but it's not exactly helpful real time. So what I did was I created, there's all these free alarms. I still use them today for if I'm day trading, just to remind myself to glance over at the screen, because I'll get distracted with a phone call or something else, and I'll forget that I've got a trade on. So you set up these timers on your computer and have it just beep every 5 minutes or every 10 minutes or a half an hour, or whatever you want to do that you don't think will bother you too much. And have a little sign up there, like a sticky note on your monitor, and says, be aware. And just pause for a split second and ask yourself, was I aware of what I was doing right then? Or was I totally immersed in the process of trading or writing a book or talking to somebody or anything? I mean, when I'm talking to somebody on the phone, I'm still in the back of my mind concentrating on how long is this phone conversation's going, what else I got to do, what's my next appointment. I've got all sorts of things going on. My wife has a saying, you don't want to be in Tom's head. Um, uh, there's some truth to that. So there's a lot going on. I don't have any trouble going to sleep. By the time I get to bedtime, my mind's pretty much ready to shut down. But
Wow.
but what ends up happening is that's what I did to increase my awareness. And what you find happening is, say every 15 minutes you got this alarm going off and you're aware, and you check it out and you say, oh, I was just totally engrossed in doing this trade and I was not aware at all. That was not good. All right. So now you say, okay, how do I feel now? What's my tension level? Am I neutral, sort of balanced with respect to this trade that I'm about putting on? Or am I excited about it? Or am I greedy about taking profits that I shouldn't be greedy? I should just be following my strategy, moving up my stop if I can, or whatever boring thing that you should be doing. You weren't that way. You got emotionally out of this nice neutral that you were in before, and you finally caught yourself. So then what you do is mentally put yourself back into the right mental state, and you keep going. And then 15 minutes later, you get another reminder and you say, darn, I wasn't aware then either. And you just keep trying to get better at that. And then all of a sudden it'll go off and you say, oh yeah, I was totally aware. I got it. And then you'll go off the wagon again and you'll screw it up the next time.
Yeah.
And then, but after about, I don't know, weeks of doing this, I found myself most of the time aware. I almost like didn't even need the alarm anymore. I could just look at the note and immediately answer the question. Yeah, I was aware. I was writing this big email to a client, but at the same time, I'm being aware that somebody's coming in the front door and that I'm sitting here, and I could be aware just in the tension in my fingers. I could tell I was getting more stressed just by how I felt like the inside of my fingers would get a little tighter, and I could just feel that. And then I could just go like this and make it go away. So you kind of get more and more aware as you keep trying to do the exercises. And as you ramp that up, then pretty soon you're aware all the time. So now when you're trading, you're kind of find yourself aware of what's going on, and you start saying, wow, look at how much I'm making on XYZ there. This is interesting. And then you're aware of that and say, Tom, just cool down, just follow the strategy. You don't have to do anything. You're always going to have one or two that are going to be doing real well, and you're going to have some that have a red number, and it's going to be a big number, and you're going to just say, okay, well, that's still within the plan. That happens. And then you start playing this long-term, more strategic game, and you can step back from the excitement and be much more aware of what's going on. It's just a progression of exercises to try to get you there. And you could always look for books. I mean, you may know them, Sarah, better than I. I'm not the investment psychologist here, but there may be books on improving your awareness. I don't know. I'm sure there are. I
Yeah,
can't.
totally.
Yeah.
But I think that your advice was great, and a lot of traders, at least in my experience that I talk to or I work with, they think they are aware, self-aware, and they might know what's happening, but it's not only about the awareness, is it? It's about having these capacity to all these non-judgment view. And so that's exactly what you're describing here, is that okay, what's understanding in the now. And it actually reminds me as well of some of ways of meditating, which is we are allowed to go a little bit into other types of thoughts and get out of the present, but then we have that sound that makes us remind to go back. And that's the moment that's valuable, that millisecond when you hear the sound and you put yourself back into the present. That's being aware. So it's complicated to be always aware continuously, especially if you're practicing that. But as you do more of what Tom is saying, using the reminder, using the alarm, and then it kind of starts to be a part of yourself and autopilot mode, and you all of a sudden don't need the alarm anymore, but it needs to be there, the plan of action. So that's really important. What about the self-confidence, Tom? You referred that back in the days when you had to do these book presentations, the hands were shaking. How did you overcome this? Was it a breakthrough? What happened?
For me, it was playing basketball in college. I ended up having to be aware enough to call out the defenses. That we had 5 guys on our team, and we were all about 6 to 6'3" in height. So we had to run the other team to death, and I always covered this monster of a guy who was the center that we were going up against. He was always taller than, bigger than I was. And what I ended up having to do is to have the self-confidence to have a plan for the whole game, to know that I was going to get pushed around a lot and get a few elbows in my face. And in being kind of a shy kid, um, I had to sort of just grit my teeth and get in there and mix it up a little bit, knowing that this big guy probably wasn't in as good a shape as I was. And by the time we got to the second half of the game, or even the fourth quarter, we would just completely kill the other team, because they would be totally gassed. They would not be, they'd be out of breath. We would just run up and down the court, score a lot of points. And the guy that I was covering wouldn't even be around anymore. He'd either be fouled out from giving me elbows in the face, or he'd be just totally walking up and down the court while I'm running. And he couldn't cover me. I didn't have to cover him because he never showed up. So, and that kind of, I guess, the success we had with putting a plan together and then winning 3 out of 4 intramural basketball championships in college and destroying teams and scrimmaging against varsity players and all that just kind of gave me a lot of, wow, this is really working. I'm this nobody who never even played high school basketball, and I'm, scrimmaging with our varsity team for the college. And wow, in a few short years. And I think that built up my confidence to come up with a plan and realize that, I have my limitations. I'm only 6'3". If I'm covering a guy that's 6'7" and twice as fast as me, it's going to be a long day, I realize. But, come up with a plan, at least try to execute it, and be confident in trying to execute to the best of my ability. And you earn that guy's respect for sure. And, that's kind of built the self-confidence. And then when you got into trading, the same thing applied a little bit. The lessons from basketball would be to create a plan, to execute the plan, be happy that you executed the plan. A good day of trading is not whether you made money or lost money. It's whether you executed your plan flawlessly. If you did that, it's a good day trading. The market decides whether you make money or not. You just are executing your plan. So a trader, if you focus on executing that plan and letting the results be what they are, that's a good day in trading. And you get better and better at that. And you really realize that you're pretty skilled over the long run. And you're going to have more good days than bad days. And, in terms of profits, and, the results take care of themselves, and you have a 50-year career,
Yeah, definitely. That's so valuable, Tom. Really, thank you so much. I think we've covered so much in this call. It went so fast. I mean, my opinion, time just went, just flew by. And I really appreciate you having come here and share your expertise and your opinions and how everything went in your trading journey. So yeah, everybody, thank Tom for coming. And there's a recording of this, so I'll be sharing it with your community and also with Tom. You can share it with whoever you intend to. And Tom, really nice to have you here. And I wish you a beautiful day. I know you're still starting here in Spain. It's already 6 in the noon, and you guys as well might be in the US as usual. But yeah, thank you so much.
My pleasure. It was great being here, Sarah. We can do this again if you want.
No, that'll be awesome. Thank you, Tom. And everybody's thanking you here on the comment section.
I see
And I
that.
think perfect. Well, enjoy everybody, and we see in the community. See ourselves in the community. All right. Bye bye.
See you.